This week, the US dollar story has been driven by three major themes: the Iran conflict, rising US Treasury yields, and growing expectations that the Federal Reserve could keep interest rates higher for longer. And together, those themes pushed the dollar index close to 6 weeks highs during the week. At the start of the week, markets were focused heavily on geopolitical risk. Tensions between the United States and Iran kept traders nervous, especially with uncertainty surrounding the Strait of Hormuz, one of the world's key oil shipping routes. As oil prices climbed, investors started worrying that higher energy costs could push inflation higher again. And that immediately changed expectations around the Federal Reserve. Instead of focusing on rate cuts, markets started discussing the possibility of future rate hikes again. That shift helped support the US dollar throughout the week. Then came the economic data. US manufacturing PMI surprised to the upside at 55.3, hitting a 4-year high and showing that parts of the US economy are still holding up well despite geopolitical uncertainty. Jobless claims also stayed relatively low, reinforcing the idea that the labor market remains resilient. And because of that, Treasury yields stayed elevated. The US 10-year yield climbed toward multi-month highs, while the 30-year yield pushed to levels not seen since 2007. Higher yields continued attracting demand into the dollar, but midweek the market mood shifted briefly. Reports started circulating that the US and Iran were making progress toward a potential agreement. That improved risk sentiment across global markets. Oil prices pulled back, the dollar softened temporarily, and currencies like the euro, pound, and Australian dollar recovered slightly against the greenback. But the optimism didn't fully hold. Conflicting headlines later emerged around Iran's uranium stockpile and control over the Strait of Hormuz, bringing uncertainty back into the market, and that helped the dollar regain strength heading into Friday. The Japanese yen remained one of the biggest pressure points this week. USD JPY traded close to the 160 level again, the same zone that previously triggered intervention from Japanese authorities. The combination of high US yields, expensive energy prices, and weak yen sentiment kept traders watching closely for possible action from Tokyo. At the same time, markets are also focused on the Federal Reserve transition. Kevin Walsh is preparing to officially take over as Fed chair, and traders are now trying to understand how aggressive the Fed could become if inflation remains elevated. FOMC minutes this week reinforced that policymakers remain cautious on inflation and are prepared to keep rates restrictive for longer if needed. So right now, the dollar is being supported by strong US economic data, high Treasury yields, and ongoing geopolitical uncertainty. But if a confirmed US-Iran agreement eventually reduces oil prices and inflation fears, that could change the direction of the dollar very quickly. So, heading into next week, do you think the US dollar continues pushing higher, or could easing Middle East tensions finally slow the rally? Drop your view in the comments below.